Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 15th of June. I'm Daniel Lam, your host for the podcast. In every recent client meetings, all the clients have been asking about gold. The key point that I would like to make is that investors should really treat gold as a long-term investment. Why? Well, the central banks are now the main buyers of gold. Hence, it would help if we think in terms of what the biggest buyers are thinking. So why do central banks buy gold? Well, they want to diversify away from the US dollar. This is a long-term trend that is not going to change. And the central banks are in it for the long term. So we should not be treating gold as a speculative or tactical instrument. Now, in the podcast at the beginning of the month, we spoke about gold being a reliable inflation hedge. So between 1971 and 2020, gold delivered an annual growth rate of 8 to 10%, significantly outpacing consumer inflation. Gold was also indispensable during periods of stagflation. Such an environment is also the key risk that investors are seeing right now. Since 1973, gold has given a 22% average real year-over-year total return during stagflation. Gold protects against recessions. Since 1973, gold has outperformed the S&P 500 by an average of 37% during 6 out of 8 documented US recessions. Finally, gold diversifies portfolio during crises. Gold carries no credit risk during periods of economic uncertainties. On average, across major modern crises, gold returned 7%, while the S&P 500 averaged a 29% loss. Currently, gold prices have breached the 200-day moving average, a level that has been supporting the prices since October 2023. We expect price action to become more vulnerable in the near term due to macro headwinds. Gold has started taking the cue from real yields again, and stronger than expected non-farm payroll numbers triggered a sharp move higher in the US dollar and in Fed rate hike pricing by the end of this year. Nonetheless, this headwind can provide long-term opportunities for investors to be adding gold. A reasonable way to consider is to add gold in tranches. For example, at the current level, at just under $4,000 and also around $3,700 US dollar. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.